how much worse can home prices possibly get? The median age of a first-time homebuyer is now approaching 40, not even accounting for the people who will never buy a house. 1% down mortgages are becoming increasingly common, and so too are 40-year terms. The median family now needs to spend almost 40% of their income to cover the median loan repayment, and that's before counting income taxes and other expenses like insurance, property tax, and maintenance. In certain cities, this number is over 90%, which effectively just means that the average family cannot afford the average home. For most people, the only feasible way to buy a house is to have just sold a house, with first-time buyers now representing the smallest share of the market since economists started collecting this data over 4 decades ago. The numbers are not great, but at least they seem to suggest that affordability can't get any worse, right? Well, I hate to break it to you, but there are a lot of emerging factors that could make home prices much worse.
More than 3 years since graduating from college, 25-year-old Zoe Zarenda is back in her childhood bedroom in Connecticut.
40% of those in multi-generational homes cite financials as the reason for cohabitating.
But the bank of mom and dad is playing a bigger role in buying houses.
It's becoming difficult as major insurance companies pull some of their coverage options.
It means I have to work extremely hard to be able to afford a nice house one day.
Now, before we get into crushing your hopes and dreams, there is some good news to get out of the way first. The median sales price of a household in America over the last 3 years has actually trended downwards from its all-time peak in 2022. Now, a lot of people will point to this as an early sign that building initiatives and affordable housing policies are starting to work. However, while this chart looks like it could be heading in the right direction, there are some things that you should know about the data it is presenting. Median sales price can only track the homes that actually get sold, which is still down significantly. According to the National Association of Realtors, there are now almost 25% fewer houses trading hands every month than there were before the pandemic, and almost 40% fewer than there were just 4 years ago. Now, you probably already know some of the reasons behind this. People who were able to lock in sub 3% mortgage rates 4 years ago are simply not willing to sell their homes even if they move to a completely different city. They would rather rent out their existing home to someone else while they go and rent a house themselves. This trend has actually been even more important in other markets, so remember it for later. This number also depends a lot on the type of houses that have been selling. The reality is that the people who have been forced to sell their home are more often than not those on lower incomes, and simultaneously, the only homes that buyers can afford are more likely to be budget-friendly starter homes. The Case-Shiller Home Price Index, which accounts for these variables, still shows that home prices are increasing pretty consistently year on year. But even with that nuance around the actual data, there are levels to this game. Even with all of the problems that the American housing market is causing for society, we actually have it pretty good compared to almost every other country on Earth, according to the numbers anyway. There are probably already some Canadians and Australians in the comment section telling us that we have no idea how bad it can get. There is probably also someone from London telling them that they have no idea how bad it can get. But what most of them probably don't realize is that there is a level of housing unaffordability even beyond this that honestly puts the rest of us to shame. In the hierarchy of housing crises, we are still on level 1. So then what would it take for us to step up our game, so to speak? Well, the first level above us would be cities in places like Canada, Australia, New Zealand, and certain high-income parts of Europe. Across America, our average house price to income ratio is 3.4. This is simply a straight calculation of how many years of the average household after-tax income you would need to earn to buy the average house. It's not a perfect measure, but we will get into the problems with it soon. But as a starting point of comparison, the UK has a ratio of 8.7, Australia 8.4, and Canada 9.5. If our real estate market started to look like these places, then the average home price could easily double or triple from where they are now. So the obvious question is, how is that even possible? Well, there are 4 big differences, so let's go through them from least to most concerning. The first difference is that this data adjusts for home sizes and scales all homes to 90 square meters, which is the equivalent of roughly 970 square feet. Per square foot, our homes are significantly cheaper, but instead of making them more affordable or just constructing them out of something other than chalk, popsicle sticks, and hot glue, we have instead chosen to just make them bigger. Now, this is made worse by the fact that we generally do not share our households nearly as much as people do in other countries, although that is starting to change out of necessity, but I am getting ahead of myself. Either way, It's not exactly fair to compare $500,000 7-bedroom McMansion to a $500,000 studio apartment, even if this trend has caused other problems like urban sprawl, huge transport costs, and more expensive utilities and maintenance. But even accounting for home sizes, that still doesn't explain the whole difference. If by some miracle we were willing to actually give up our third guest bedrooms, house prices still have a lot of headroom to rise much higher than they are today if we are not extremely careful around some major issues. So it's time to learn how money works to find out how much worse home affordability can really get. This video is sponsored by Odoo. Odoo is a complete business management platform that brings everything together: sales, CRM, accounting, inventory, manufacturing, and more, all in one place. What really stands out is how seamlessly everything connects. You can choose just the apps you need, and they instantly work together to keep your business running smoothly. From predictive lead scoring and CRM to real-time inventory tracking, Odoo takes care of the details so you can focus on the big picture. We've actually been using Odoo ourselves. Both our newsletter, Compounded Daily, and our book recommendation hub, How Money Works Library, now run entirely inside Odoo. Managing subscribers, content, and updates used to take forever, but Odoo keeps everything organized in one dashboard so it's faster and way easier to maintain. It's also super intuitive. Whether you're sending invoices, tracking inventory, or launching a new project, the interface feels straightforward and efficient. If you want to see how Odoo can simplify your own setup, try it out with the link in the description to get a 15-day free trial or keep any single app free for life. No credit card required. So one other thing that we have going for us that has kept our real estate market in check, if you could really call it that, is that we are actually pretty good at spreading out. Now that doesn't just include the car-centric urban sprawl that we have become famous for. Sure, our cities are generally more spread out than our friends in the old world. But we are also more spread out between these cities as well. Demographers use something called urban primacy, which is a rough indication of how concentrated a population is within a single city. All it does is measure what % of the country's entire population lives within a single center. Here in the US, about 7% of our people live in the New York metropolitan area. Now, that's still a lot of people, but when compared to most other high-income countries, even those with more space than us, it's actually incredibly low, indicating that we haven't put all of our real estate eggs in one speculative basket. Now, this is actually even more significant than it looks, because we have a lot of decent runners-up. You could add together our 10 largest cities combined and it would still account for less than a quarter of our population. A small caveat is that we are actually so good at spreading out that this data is open to some interpretation, because it is difficult to know exactly where to draw statistical borders around population centers. Either way, if we compare our urban primacy to a country like Australia, we are already significantly more diversified. But if we include the second largest city in this calculation, then almost half of their population lives in just Sydney and Melbourne. This urban concentration drives prices in more ways than you might expect. Firstly, of course, if everybody is fighting over space in just one or two cities, there is less supply and more demand for small areas of space, even if the rest of the country is very large. But less intuitively, it also creates the same problem we are seeing in the stock market right now. If just a few centers dominate everything else, then they attract most of the investment and get most of the opportunities. In cities like London, Sydney, Auckland, and Vancouver, this has created a trend where people will live and work in big cities with jobs and opportunities. But since they won't be able to afford a house there, they will use their higher earnings to buy a house in a different city and rent it out. This rent vesting strategy is becoming far more common back here in America, thanks to people who tried to move out of major centers during the pandemic, but now don't want to sell their homes because of those low locked-in interest rates. This has basically let us outsource the housing crisis into a lot of cities where people don't earn enough to compete with the few centers that are driving the most growth. These other countries have had a big head start, but we are heading in exactly the same direction. A report by the Bureau of Economic Analysis found that as of 2024, just 31 counties accounted for more than 1/3 of the country's entire economic output. This statistic has only been getting more concentrated, as certain industries like finance and tech have become increasingly dominant, while other industries have seen continual declines. Now, there was a really nice chart prepared in the Bureau's report showing this, but their site has gone offline during the government shutdown, so for now you are just going to have to trust me, bro. Anyway, as job opportunities continue to consolidate, we are already seeing house prices in certain cities outpace the already elevated prices everywhere else. For a property roughly the size of a 2-bedroom apartment, the most unaffordable city in America is New York, where average prices are 12 times average disposable incomes. This is close to what we see in cities like Sydney and Vancouver. They are slightly less affordable, but the difference is a lot smaller. The problem is, this basically means that in these countries, half of their people deal with housing affordability problems that are just as bad as New York. For now, we at least have the luxury of alternatives. But if industries continue to consolidate, more and more of us are going to have to make the same decisions, picking between a place where we can afford to live and picking a place where we can get a decent job. But it gets worse. A 2-bedroom residence in Sydney costs 12.5 times the city's average household disposable income. In Beijing, Shanghai, Taipei, and Colombo, that ratio is approaching 40 times. Someone would need to dedicate more than 30 years of their entire take-home income to afford a home that would be considered extremely small by our standards. These cities are often ignored in the usual lists talking about the most unaffordable places to live, because they are not in the OECD, and their outright prices are not quite as high. But they still show that we are not even approaching the limits of how bad the housing market could get. Property in these cities are almost as expensive as similar properties in major American cities, but the average wages are significantly lower. So, how do these people afford it? Well, their homes are, on average, much smaller. According to data compiled by respective housing departments, the average American has approximately 900 square feet of space per person in their homes. In cities like Hong Kong, Shanghai, and Seoul, the numbers are between 170 and 300 square feet per person. People afford these homes by banding together savings from multiple generations and then living in cramped conditions, often while paying off extremely large mortgages. Now, if you are thinking it, then yes, you are right. Culturally, multi-generational housing is much more common in these countries. However, when people are living in a 2-bedroom apartment with 8 other people from 3 generations, they are doing it out of necessity rather than tradition. Now, I want to make 2 things clear. The first is that, to be fair, we are a long way from this kind of situation, for now. But the second is that it's pretty dangerous to assume that the unaffordable housing problem has a natural limit. If we aren't very proactive with policies around home construction, responsible lending, and new development, there is nothing to stop us trending in the same direction. In fact, we kind of already are. For the first time in over 160 years, the number of people living in the average American household actually went up, despite declining birth rates, simply because more generations were living in the same home. At the same time, in more than 50 years, average houses started to get smaller. Now, I would love to conclude that we are all simultaneously getting closer to our families and more environmentally conscious at the same time. But let's be honest with ourselves. We are doing this because we have to. Now go and watch this video next to find out why most of the policies designed to reverse the housing crisis only end up making it worse. And don't forget to like and subscribe to keep on learning how money works.